Coming up today, the S&P 500 hits a new milestone. Many investors don't believe it. Robinhood rips up on a new announcement. Microsoft's AI breakthrough. The hottest stocks from today. And Trump's handwritten note to Jay Powell. It's going to be another good week, guys. Let's go. Well, there we have it, folks. The last trading day for Q2 and the first half of 2025. Just on a pretty good note. Overall, looking at the market, a few pullbacks there for some mega cap tech stocks. Otherwise, it was mostly a green day. And to switch the heat map over to year-to-date return, having a look at some of the most popular stocks and how they've performed in the first half of this year. You can see a bit of dispersion there in mega cap tech. Alphabet, Google, still lower in the year. Same with Tesla. Apple really not having a good year. Microsoft going the other way. Nvidia doing now that it's just popped up to brand new all-time highs. And it's actually Meta, the best of the Mag 7, up 26% year to date. Looking across other sectors, still a little mixed out there. A lot of checkered breadth in year to date returns. And just looking at popular ETFs to give you a bird's eye view of how global markets are performing year to date. We've still got discretionary, retail, healthcare, biotech, and energy stocks down year to date. It's actually financials and tech, some of the best performing sectors. And doing even better than American stocks is still international stocks, even emerging market stocks, still on healthy double-digit gains so far this year. There's a look at fixed income with TLT just above break even. High yield bonds doing a little bit better. We've got Bitcoin up 15% year to date and doing even better than stocks. Gold up 25% year to date, and gold miners have really come to life these last few months. Now up more than double the underlying commodity, 53% year to date. And here's a look at the top 10 best performing S&P 500 stocks for the first half of this year. Palantir out in front. NRG Energy, big comeback for Super Microcomputer after that was smashed down last year. GE Vernova, still on a monster run ever since it's done its spin-offs. Newmont Gold Miner. I'm happy to see one of my favorite stocks show up on this list, Uber, which has also been performing really well so far this year. And just looking at gold, it's actually having its best year-to-date performance since 1979. Really in blue sky territory here. And that's likely helped by the US dollar having its second worst year since the late 60s, actually, giving tailwind to commodities. And what's been a really big divergence with US 10-year yields. And just looking at the S&P 500, we're now right smack bang on the average total return path, 5.6% year to date. And overall, the market will average somewhere around 9% in the long run. But you can see we're still well below some of the best performing years like 1995. And I'd say how we've finished Q2 and the first half has probably surprised many investors, as we've actually just seen the quickest recovery following a decline of at least 15%. The tariff drama had many people convinced we were in or on the cusp of a recession. And down here at the lows, pessimism actually reached the same levels, and on some measures even exceeded that of the bearishness we saw at the height of the global financial crisis back in 2008. It was incredible. But like I said back then, I didn't think the underlying conditions of the economy and markets were nowhere near as bad as 2008. It was all based on expectations and a loss of confidence. The soft data fallen off a cliff as opposed to the hard data. But now, as markets often do, we have flipped back and pretty quickly. Fear and greed index now on firm footing at 67, and the S&P 500 just crossing 6,200 for the first time ever as we continue to melt up on low volatility here. We are a little elevated in the short term. My S&P 500 oscillator, which looks at a lot of market internals, now in an overbought level of 61, which can mean the market is ripe for a little pause. Just looking back the last few prior times, we've got these overbought readings on my oscillator. However, if it were to stay there, like we saw in late 23, after a correction in the market, that's a really strong technical signal. That short-term persistent overbought readings bodes well for the medium and long term, actually. So the market could keep grinding here, as what really caused it to sell off has been well and truly digested. Financial markets remaining optimistic that tariff deals will be done before the end of the 90-day pause next Wednesday. So far, we've only seen the UK and China agree to trade frameworks, but US Commerce Secretary Lutnick said the US may finalize around 10 trade deals ahead of the July 9 deadline. We also heard US Treasury Secretary Bessent suggesting that the 1st of September Labor Day holiday as a target for deal completion. If we don't see a bunch of deals in the next week, they'll just extend the deadline. So it should be a nothing burger here for markets. As a reminder, this is a shortened trading week. Markets will close 1 p.m. Eastern Time on Thursday, and they'll be shut all day this Friday in observance of Independence Day in the States. Also out this Thursday, non-farm payrolls. US economy expected to have generated 113,000 new jobs, with unemployment rate coming in 4.3%. And just as a reminder, if you're into trading stocks, ETFs, and options, then subscribe to this channel, Click Capital, as I make these videos every day after US market close to keep you updated on everything important happening, along with sharing what opportunities and risks I currently see out there in the market. And stick with me today, because I'm going to show you later on in this video an up-and-coming stock in a super hot industry that's looking primed to break out on the chart to me. You don't want to miss that one. Just getting back to a little bit of seasonality here. 10 of the last Julys have finished higher for the S&P 500. To go all the way back to 2014, we finished a touch lower. And July is actually one of the best performing months looking at the seasonal calendar here for the S&P 500, especially adjusted for volatility as well, looking at the average standard deviation. And in fact, zooming in a little bit further, the first half of July is actually the best median 2-week returns for the S&P 500, and by quite a margin as well, almost 2% the first 2 weeks. Getting even more granular again, the first trading day of July is one of the best performing days as well. Looking back at the last 20 years, it's finished higher 90% of the time. And since the options market's got the VIX one day at 10, they're also pricing in tomorrow's a good day. But have we come far too fast after having one of the most dramatic sell-offs? In fact, we did get 3 standard deviations below many averages. Some showed up as 4 or 5 standard deviation moves. Looking at the NASDAQ 50-day trailing returns, we're now back to a 3 standard deviation bounce. And we can see that here on the chart, especially when I expand it, just what a dramatic V-shaped recovery it's been. But even though we may be a little stretched here in the short term, that by no means is a bad signal for the medium term. In fact, it's the opposite. Looking at a list here of the biggest 12-week gains in the S&P 500, we've just done a bit over 22% now. Looking out 6 months, we're higher pretty much all the time, bar once in 98. Looking at a year, we're higher 100% of the time for an average gain of 24%. That shows that momentum begets more momentum in stocks. It's the most persistent, anomaly, and robust characteristic there is in markets. And I've seen studies that have tested momentum on pretty much every market in the world going back hundreds of years, and it holds up better than any other factor. In addition to the really strong rebound we've had, we've also just had the biggest VIX crush ever. That same 12 weeks, we've gone from 45 to 16 in the volatility index. That's a 64% crush. And I think that's also a feature of modern day markets, these sharp VIX spikes and monster crushes. But that just shows forward expectations of volatility have been sucked out of the market. And again, looking back in history, that bodes really well for forward returns. And there's a look at the VIX and the monster crush we've had since the tariff drama. Now just hovering around multi-month lows, but still not near the lows we've seen back in January. Actually got down to a 14 handle. And even in December, we briefly touched 12.7. Still room to grind lower, especially with the S&P 500 at all-time highs. But what about market breadth? Still not quite the best here. 53% of S&P stocks above their long-term 200-day moving average. Well, that's not necessarily a bad thing. In fact, it shows that there's room for the market, many stocks to actually catch up. And we can see that in the stats here. When the S&P is at a 1-year high, while less than 60% of stocks are above the 200-day MA, look at forward returns, even 2 months later, 100% higher. 6 months and 12 months, the market's higher 100% of the time with good average returns. But the fact is, still got many investors that don't believe it. And some think that's reason why the market can't continue. But in fact, again, it's the opposite. This is how bull markets grow, by climbing a wall of worry. Many people on the sidelines, many people skeptical. I'd say this is one of the most hated rallies and bull markets I've ever seen in my 20 plus years of investing. And something I've seen ever since I've pretty much started this channel 2.5 years ago. I'm constantly being told why this is a fake rally, why we're on the verge of a crash any day now, because we've got a PE of 23. But the fact is the market keeps grinding higher, and I think it's got even more reason to do so now. Deregulation, lower tax, AI, retail participation. Just because PEs are at 10-year highs doesn't mean the market's just going to reverse. And the fact is when everyone's bullish, that's when we are typically closer to a top. We've still got sentiment surveys with more bears than bulls. It's unbelievable. We're at all-time highs. But that's just one sentiment indicator, the AAII Investor Sentiment Survey. Looking at other sentiment measures, global equity flow is definitely right up there, risk on. It's a global equity bull market. Like I said, international stocks are doing better than American stocks. Bonds doing really well. Credit markets don't see any risk. We're seeing huge options volumes into calls. Momentum stocks waking back up, but we still do have a few indicators that are not too stretched here at the moment. But the biggest driver of the stock market is still holding up, and that is corporate earnings growth. In fact, this quarter we just completed today is supposed to be the lowest quarter in year-over-year EPS growth that we're potentially going to see for another couple of years. In fact, analysts are expecting corporate earnings to accelerate next year, and I think that's very possible given the profitability gains that have been driven from AI, not just the huge capex spending, but tech companies being able to do more with less staff. Their profitability per employee is on the way up, and we could still be on the cusp of what I've been calling for over a month now, the US comeback trade. I was looking at international equity ETFs by country. The proud Polish out in front, 51% year to date. Greece, Spain, South Korea, Austria, Italy, Germany, the Euros having a good time by the beach watching their stocks go up. Well, the States are still down near the bottom end of the list, as there was a mass exodus on USD assets on the back of the tariff drama. But like I've always said, and like we're already seeing, the States is bound to come out on top with new trade deal in favor of American companies. And just looking at consolidated equity positioning, it is still overall underweight and well off peaks. Even though we're a little hot here in the short term, there's still plenty of room for the remainder of the year for big money to come back into US stocks. And when that happens, you'll typically see the growth leaders outperform. And I think we're already seeing it today. One of my favorites of late that I've been telling you guys, Robinhood, growing leaps and bounds, offering new product after new product, expanding across the world. We just heard them make a major announcement today. They will allow European customers to trade more than 200 US stocks and ETFs as digital tokens, and is developing its own blockchain. Now, this is really big deal for EU customers, many of whom contact me all the time. Due to their overregulation, many of them can't buy US ETFs. They're not allowed to. The law prevents them. And even going further than public markets, they're also making stock tokens of OpenAI and SpaceX available to European users, blurring the lines between public and private market. Also going to roll out perpetual futures on Bitcoin and Ether. And this is on top of them getting into more traditional banking products, savings, retirement, mortgages, credit cards. Like I said, they're coming for old school banking in a big way. As Vlad Teniv does a great job at leading his company. The guy's still only 38 years old. I think he is a generational founder. We're going to be seeing him around for many more years. And good news is, Robinhood hasn't even been added to the S&P 500 index yet, with hundreds of billions of dollars mandated to buy its constituents. I think it was really close to being added in the last quarterly rebalancing, but I think it's highly likely now. The index committee will have to jump on this train, as it is now a big name. But many investors aren't waiting for their approval. Stock ripping up over 12% today, still going after hours as I speak. And look at that volume. Even though we're at all-time highs, still put in 100 million shares today. Big money coming in here. And like I've been telling you guys for a few weeks, market cap still well under 100 billion. I think this will definitely be $1 trillion company one day. It's just a matter of when. And so that's fintech and crypto, which is hot, but also let's not forget what's behind this whole bull market to begin with. Artificial intelligence, second largest stock in the market after Nvidia, which also gave me a payout in prediction markets today. Microsoft came out today and said their AI diagnostic tool can outperform doctors. And this is something else we're seeing disrupted with a lot of hot healthcare AI stock. Microsoft said it's built an AI-powered medical tool that is 4 times more successful than human doctors at diagnosing complex ailments, as the tech giant unveils research it believes could speed up treatment. As they're taking a step towards what they call medical superintelligence. Like I said, it's just a matter of time before AI and robots replace a lot of jobs out there. But Microsoft's already a $3.5 trillion giant. Me personally, I'm looking for a little bit more of a high beta exposure to this theme, and that's why I've got shares in Grail, also using AI to help in the early detection of cancer. And that also had a good day, breaking up to multi-month highs here. But what Wall Street still has mixed feelings on is Alphabet Google. They're not really sure what chatbots are going to do to their golden goose, search. I believe the market's totally misreading it. And I know that's a big call, and you think, how could a stock as big as Alphabet or Google be undervalued? Well, again, that's another characteristic of the market. Seen it time and time again. I recall seeing it with Apple in the mid-2010s. Some of you may remember I had cheap PE. I think it got down to like 11 or 12. Even though everyone knew about it, we all had iPhones, because back then it had a market cap around 500 billion, and the narrative was, surely it can't hit $1 trillion, and it stayed undervalued for many years. Soon after Warren Buffett started buying shares, and in fact, I was fortunate enough to buy Apple shares back then as well, and I did quite well out of it, which helped me to buy my first house. But now, in my opinion, Apple has reached fair value, especially over the last year. It was no surprise to see Buffett trim his position in it. But back to Alphabet, I think the same thing could be happening. The market's worried about what AI is going to do to its search revenue, but it's writing off all their other businesses. Cloud, YouTube, Waymo. But more importantly, I think the market might be surprised when it realizes Alphabet Google actually has the best AI model. It's just yet to fully monetize it. Gemini. They're already integrating AI across their products as upgrades, premium services, but I think Gemini could end up overtaking GPT in the next year or two. It's already seeing better growth in the last couple of months. And not only do they have the better AI model when statistically measured, it's grown leaps and bounds the last couple of months, they have the biggest user base and the biggest advertising infrastructure. They're going to monetize chatbots better than anybody else. GPT does have a great product, premium service, tens of millions of users locked in, paying every month, but they don't have the huge advertising network that Google does. We will eventually see ads throughout these chatbots, throughout answers. Google will monetize that better than anybody else, and you're probably the same as me. When you're looking for a local product or service or something to buy, online shopping, are you going to GPT or are you still going to Google? There's Google, right? Google gets the most valuable clicks, those with commercial intent. Not wanting to miss out on the whole super intelligence this trend. Zuckerberg, another big key player in AI. He's spending big to secure the most amount of AI talent in the world. And just like Alphabet, Google has the cash flow from their traditional advertising business to do it. And that's in addition to virtual reality, which Meta could end up dominating as well with the metaverse and their own range of AI product. And let's not forget, it's not just AI that Google's in on, also robotics and nuclear, another big mega trend we've got present. As believe it or not, the majority of the world's electricity is still generated from coal, the dirtiest source of energy there is. And I think give it 10, 20 years, we're going to see the vast majority of electricity generation that powers AI coming not only from wind and solar, but also nuclear energy, with uranium still one of the hottest commodities of late. Another mega trend that is still very much in the early days, electric vertical takeoff and landing aircraft, aka flying cars. Key player in this space, JB Aviation, just delivered its first eVTOL to the United Arab Emirates. Company plans out to roll out an air taxi service in the Middle East nation next year. And that got investors excited today. Stock up 11%. Again, big volumes coming in, and that's got a bunch of others looking pretty good here on the chart. Archer Aviation, and stock I'm actually invested in, Blade Air Mobility, which is kind of like an Uber for rich people. They already offer services, already generating revenue by offering helicopter and seaplanes around a bunch of key markets, New York City, Hamptons, and Atlantic City. And they too will make use of eVTOL products when they're available by partnering with those eVTOL companies, and that should help to drive their margins as well. But just looking at other key stocks on my themes watch list today, moving out there, Plug Power and other solar stocks coming back after they got slammed down 2 weeks ago. They've had a quick recovery. We're seeing good moves in some battery stocks today. In the AI trade, with Nvidia hitting brand new all-time highs, that's helping smaller names wake up. SoundHound AI up 9% today, and a strong rip there for Big Bear AI. I just closed a profitable options trade that I share with my members in the chat room today, as momentum is well and alive in these hot areas of the market. Had a bit of a pullback in quantum stocks the last couple of weeks, but they look to be waking up a little bit here today. Potentially the next group to come back to highs. Another stock I've got, Oscar Health, as we're seeing broad participation in a lot of these categories. And there's Coinbase having a little bit of a pause after absolutely ripping the last 2 weeks. Some of these other smaller crypto-related stocks could be also about to wake up. And what I alluded to at the start of this video, one stock you want to keep your eye on, relatively new to the market, just came on in May, Galaxy Digital, GLXY. Looks to be shaping up to me here on the chart, up 9% today on volume. I think this could be one of retail traders' next favorite stocks, and has the potential to turn into a cult stock as well. And they offer a number of digital asset products, trading, lending, derivatives, investment banking, in addition to AI data centers. And I think they're going to play a big role as the world transitions from traditional finance to digital finance. And so we'll be keeping an eye on this stock, as I do think crypto-related stocks could be on the verge of catching up to plenty of hot fintech stocks. Like another one I gave out to Stock Picks members, Sezzle, now up over 100% since I bought it in mid-May, as it's on absolute fire here. And you guys might remember the stock I gave out to you last Monday, said to keep an eye on. I think it's on the cusp of breaking out, becoming a retail favorite. Hinge Health had a monster rip there today, up 11%. A lot of people talking about this one online. Rare earth stocks as well. A lot of these future technologies and industries need these rare earth materials, and so they too are attracting investor attention. And I know a lot of these stocks are not profitable. Some of them barely have any revenue at this stage. And some people call it a bubble, but this might sound contrarian. If you see a bubble, you should buy it, then sell when you see signs it's broken down. There's a lot of money to be made in bubbles. And just like the famous investor William O'Neill, the guy who wrote the book How to Make Money in Stocks, one of the first guys to use computers for researching stocks, and the founder of Investors Business Daily, IBD, is famously known for saying, "I've never met a successful pessimist, but you will find plenty of them online," as that's what they use to drive views and clicks at your expense, unfortunately. But it's getting back to a bit of the macro and the pressure continuing to build on Fed Chair Jay Powell, with the US President sending him a handwritten note today. And here's a clear cutout of that note. And it reads, "Jerome, you are, as usual, too late. You have cost the USA a fortune and continued to do so. You should lower the rate by a lot. Hundreds of billions of dollars being lost. No inflation. Signed Donald J. Trump," with an annotation of where rates should be, with the note being written on top of a list of world central bank rates. United States with the highest overnight rate compared to all other developed nations. And so we very well could be on the verge of hearing his replacement. Powell's term ends in May next year. Wash, Hassett, Besant among those under consideration. We just heard from Scott Besant saying he doesn't think tariffs are causing any inflation. Jay Powell just speculating that they could to defend his stance of staying on hold, but the market may be doing his job for him. 5% chance the Fed stays on hold in September, Fed Fund futures traders think, along with the bond market as well, the 2-year 372. And I agree, I think even when the Fed meets in a couple of weeks in July, an interest rate cut could be on the table, even though I don't think Jay Powell will. He wants to hold off as long as possible for some reason. But at this stage, I'd be very surprised if they don't cut in September. In fact, I'm betting on that in prediction markets as well. And just moving on to the latest in trade deals. I was a little surprised last week to see the Canadian government come out and try and slap a digital services tax on US tech companies, which I question why would they do that and why at this most critical time in the middle of negotiations. Trump immediately came out and said he's terminating all negotiations with Canada and he'll write them a letter of what their tariff rate will be. And it appears the Canadian government have backpedaled and rescinded their planned digital services tax, which were actually set to go in motion right away, start collecting today. So it looks like the trade talks with Canada are back on. The next big one will be European Union, as they're sending a delegation to the States, as we could potentially be on the cusp of some more big deals, not just with the EU, but with India and Japan, other big ones that could be done over the coming weeks. But I don't think this headline is in play in the market. As I said, the market appears to have well and truly digested it ever since we got that surprise news that the US and China had worked out something. S&P 500 gapped up above the 200-day MA and has defended it ever since, with the VIX dropping hard that day as well, as volatility has been sucked out of this market. In addition to a big pullback in crude oil, tensions building with Iran, and what looks to be a quick, clean military campaign by the States seems to have de-escalated the situation for now at least, with crude having a sharp pullback here in the mid-60s, and the oil VIX as well having a huge vol crush, getting back down to 38. So that's a good sign for the market, should prevent inflation running away, and it appears we're well and truly in grind mode. That is until we get the next catalyst and short-term pullback, but for the here and now, the markets appear to be on firm footing. And the next thing we'll be paying attention to is the jobs report this Thursday. Like I said, the market will close early 1 p.m. 4.3% unemployment rate. Labor market has been a little soft of late. Maybe if that comes in a bit high, could get the markets a little nervous here as they are quite complacent. But as we've been seeing this last month, they just keep on shaking off any negative headline. We gap down, the dip gets bought, back up she goes. Otherwise, typically, as we go into a long weekend, trading desks shut down, volume and volatility can really dry up. And we can see that in the VIX 9-day, penciled in here at 13.7. So it should be smooth sailing until the next surprise comes along. And with that, that's pretty much a wrap for the daily market review today to get you prepped for the week. I'm always interested to hear your comments below this video. Make sure you subscribe if you haven't already. And if you want to learn more about my premium trading services and what other trading tools I use on a daily basis, then you're welcome to check out my links below this video. Otherwise, enjoy the rest of your day, and I'll see you back here again this time tomorrow. Cheers.